Okay, we are still going to continue with our topic on controlling. The last time you met, we talked about monitoring and controlling. Then we learned about what monitoring is all about. We also talked about the meaning of controlling. Then we look at the steps involved in controlling. Then we also look at the types of control, that we can have. That's where we look at the preliminary control or pre-control. We also look at concurrent control and then post-control. Then we look at the characteristics of effective control system. You say you have put down a control system and you say it is effective. We said that if it is effective, then it will be able to detect deviation on time. So we look at the characteristics of effective control system. We are going to, time wouldn't allow us, because it's a video, anytime you want to watch, you can watch if you don't understand it. So I've given you the overview of what we have done. We are continuing with our lesson on control, and today this is what we want to do. By the time we finish with today's lesson, so that is the lesson objectives. The first thing is that, so by the end of the lesson, the student, that is you, should or will be able to list at least 8 control devices. So today we'll be looking at control devices or control tools, and at least you should be able to list 8 of them. Then the second objective is that you should also be able to explain at least 5 of the control devices. So when you say list, you should be able to list at least 8 of them. And then even if you can't do anything, you should be able to explain 5 of them. Then you should also be able to state and explain at least 4 reasons for controlling. 4 reasons for control. But it is likely you will not be able to have the reasons for controlling on this video. It might be on a third video. I thought we would be able to do that, but it's likely because I realize we have a lot to do in respect of the control devices. But if time allows us, then we will continue with that. Other than that, there will be a third video. So let's now continue. So the topic is control devices or control tools. So when you say control devices, it's the same as control tools. What are they? I hope when you heard of the word tools, you are not thinking about instruments that a carpenter or any other professions will be using. Now, when you say control devices or control tools, you are a manager. What are the techniques? So the tools are the techniques that the manager uses to control the activities in the organization. And it is very simple. Let me give you an example and you understand it. You see, the tool that you use will depend on what you want to control. For example, you know, in your class, what tool does the school use to detect truancy? What tool does the school use to detect teachers' punctuality? You know, you have the register, and the class captain marks the register every day. So you see, the register becomes a control device. The register becomes a control tool. The register becomes a control technique. So that is what we are looking at. So each tool has what it measures. So like I just said, the register has what it measures, and you know, I've already told you. So if you are in an organization, managers have several tools they use to control the activities in the organization. And it's very simple. In fact, what we are going to learn here is at your level. When you move to a higher level, you learn other higher control tools. But for you at your level, SHS, at least if you know these ones, they will be okay for you. As you move to a higher level, you learn other modern techniques that managers use to control, in fact complex ones, but we are going to look at these ones are relatively simple. The first one is very simple. So I said meaning, when you say control device or control tool, what is it? I said they are the various techniques. So take note, when you say tools, we are looking at devices, tools, and then techniques. So if somebody asks you what are the techniques that a manager uses, it's still talking about the tools. And what is a control tool? What's a control device? Then there are the various techniques that managers use to control activities within the organization. And examples, we are going to look at about 10 of them. The first one is quality control. It's very simple. The name tells you what it is. Quality. When you are buying product, you say, oh, this is a quality product. You want quality product. So what is quality? When you are looking at quality, then it means that there is what you have is that you have your design specification. What do you call design specification? So what you want the product to be. Your school uniforms or your house dresses, the school gave to tailors. Yes, the school designed it and determined what they wanted. And output should conform to the design specification. So if you are looking at quality, then you are looking at the extent to which the output conforms to design specification. The extent to which output conforms to design specification. So what do you want? What has been produced? Are they at par? Or this is what you wanted, but this is what has been produced. It means that there is deviation, and then the necessary corrective measures should be taken. So when you say quality control, then it means you have, just as I told you in our previous lesson, I said, I gave a funny example. I said your father may want fufu to a certain softness, and your mother will see to that you pound the fufu to that. So there is there's a design specification, what is expected. So whatever will come out should match with what is expected. And in every organization, big organization, of course, they hire the one we call the quality control officer, which you know about. You remember when we were looking at the organizational chart, we look at the board of directors, we look at the managing director, we look at the general manager, then we have the functional managers, and then under the production manager, we have the quality control officer there. So you know what, and if you say you are a quality control officer, then you see that he's the one to see to it that the output conforms to the designed specification. So that is for quality control. And the quality control officer will have to test. They have to test the product. It has to go to lab. Maybe he has to taste and feel and do all sort of inspection to see to it that output, whatever comes out is the output, conforms to the design specification. So if there is any deviation, if he detects any deviation, then corrective measures will be taken. So, for example, if your mother is preparing soup, then she tastes it, and then there's less salt, then he will add. If there is too much salt, then she does something to neutralize the salt content. So that is for quality control. Then the next one is budgetary control. Budgetary control. Everyone knows budget. You remember when we were in school and we were talking about budget, I said some of you, or even when you were coming to school, your parents asked you to prepare budget. So you picked the item, you had a piece of paper, you wrote sugar, this, milk, this, Milo, this number of things. Then you listed everything, and then the amount involved. you wrote it against. So if you had maybe 10 items, all summed up to, let's say, 800 Ghana cedis, and then you send to your father. Your father may accept it, your father may reject some of the items, and then whatever your father will be able to afford, he gives you money, then you go to market to buy. So we are familiar with what budget is. Now, in every organization, we have several departments, and each department may have to prepare their own budget. They have programs, we have done programs, they have projects, and a whole lot of other things. Everything may be quantified in monetary terms. Then you project how much are you going to spend on this one? Where are you going to get the revenue from? How much are you going to spend? So I indicated here that I said budget is used for cost control purpose. For cost control purpose. So if you have prepared budget, and in your budget, this is what you want to buy, and this is how much you estimated. Are you spending more? When it comes to rare terms, are you spending more than that? Are you going beyond your budget? If you are going beyond your budget, if you are spending more, because you have prepared the budget, you'll be able to detect deviation. And what is that deviation? You have estimated to spend 15,000 on something. Now you realize you are now spending 20,000. So the necessary corrective measures will be taken. And even in Ghana, every year, quite recently, the Minister of Finance went to Parliament, and he was talking about the mid-year budget. He was looking at the budget. So what he at the beginning of the year, what was he as a country? What were we expecting? How much were we expecting? And what were we expecting to spend on this, on that, that, and a whole lot of other things? How much, when you say, oh, I'm going to spend 1 billion on construction of roads. Now, how much are you spending? So you'll be guided by the budget, so that if there is deviation, if you think that for the minister, if you think that he needed more than that, he goes to Parliament and he explains why that deviation, and if Parliament approves for another supplementary budget, then that will be it. So if you go to any organization too, they prepare budget. So the budget becomes a financial plan. It's a financial plan. So that's why I've said it's a financial plan. And it shows plan in financial terms. So the budget will show everything will be quantified in monetary terms. So financial terms. And it brings actual performance at par with predicted performance. So that is, so you may be asked to operate within the budget. So if you are going beyond the budget, then you know that you need to take certain measures. So that is for budgetary control. Then the next one is production planning and control. Production planning and control. So you remember here we are looking at it is used for cost control purpose. Then production planning. So production planning and control. What is it? I said it involves 5 steps, 5 main steps. The first step, the first part is the planning. Then the second part is the controlling. The planning stage, there's what you call routine. At the planning stage, there's what you call routine, and then scheduling. So the two together are at the planning stage. So when you say production planning and control, it involves 5 stages. We shall do this one in details in your book 3 when you go to production management. So here we are just going to give summary to that effect. So routine. You know, if you want to produce something, you need to determine, you have to find out to get all the resources you need in order to produce. Your mother wants to operate a restaurant. What are the resources your mother needs before he can operate that restaurant? She needs to determine all those things. After that, you know, you are going to perform operations, several operations. So what do? You need to schedule. That means time each operation. When are you going to start doing this? When are you going to end it? When should this one begin? When should this one end? That will be the scheduling. That will be the scheduling. Others will say scheduling. Then when you have timed it, so that is the planning stage, and you put it on paper. Then the actual work starts. That is the dispatching. So you now give orders. Okay, you have planned that this is what should be done at this time. Now you give order that it should be. You should start doing this. You should start doing that. So that is what they call dispatching. Then whilst they are doing it, whilst you are giving order and they are doing it, you need inspection. You need to find out what is actually being done. You have to find out, you inspect. As a manager, you have to go around, you have to supervise to find out what is being done. Well, others will also not bring this inspection, but they will say loading. So others will say routing, scheduling, dispatching, and then loading. When you say loading, you see you need to determine what each worker has to do, what you need to, what the capacity of each machine. You have to determine all those, and then you assign. So that is the loading. What can this one do? Who can do what? What is your capacity? What is the capacity of the machine? You need to look at all those things. Then the last aspect will be the follow-up, or you call expediting. That is the follow-up. And what is it? It checks, this one checks progress of production. So it is called watchdog function. It is a watchdog function, and it checks the progress of production and sees to it that it is carried out as planned. Whatever you do is carried out as planned. You remember we learned when we were talking about the steps involved in controlling. The second step, you say you measure performance. Yes, that is what this one does. So it measures performance, then it compares the performance with the standard, so that if there is any deviation, the necessary corrective measures will be taken. So that is production planning and control. Then you move to audit control. Some of you one day will become auditors, and you probably know what it means to become an auditor. So audit control, you have accountants. They prepare financial statements, and they give financial reports, and so on and so forth. Now, the accountant has somebody who checks him so that he doesn't do the wrong thing, whether he's doing the right thing, whether he's the right procedure and financial reporting is being carried out. And so one day, if you become an auditor, that is what you'll be doing. You want to find out whether the accountant is following the right procedure and is giving the right financial reporting. So the audit control ensures proper accounting procedures and financial reporting are being carried out. So if the auditor, whether the internal auditor or the external auditor, finds out that the accountant is deviating from the course of action, then the necessary corrective measures will be taken so that you'll be able to achieve the organizational objective. So that is audit control. It ensures that proper accounting procedures and financial reporting are being carried out. And if he detects deviation, then the accountant will be questioned as to why that deviation, and then the right thing will be done. That is the point where the accountant, if he has embezzled funds, it will be detected. If he has misappropriated funds, it will be detected. Money that was earmarked for something, he uses it for another thing, then it has been misappropriated. If he uses the organizational funds for his personal gain, then it has been embezzled, and you'll be held accountable for that. So that is for that one. The next one, another tool, is performance appraisal. This one, if when in your book 3, human resource management, you'll be looking at performance appraisal. It's a very simple and straightforward concept. When you say performance appraisal, I'm a teacher. Every year, my head of department will have to conduct performance appraisal in respect of everybody in the department. Okay, at the beginning of the year, you had targets. What were you supposed to do your performance, not you as a person, your performance will be measured against the set standard. You see, when you come to school every semester, I give you what the first time we meet. If I ask you what do I give you, you'll be able to tell me what I give you. What are we going to do for the semester? I give you this date, we shall do this. Today we are going to do that, we are going to do that date, and all those kind of things. So that one we estimate. So what we are supposed to do. But and what was I able to do? When am I supposed to be coming to class? When do I come? And a whole lot of other things. How am I involved in other activities apart from teaching? So my performance in its totality will be measured against set standard, so that if there is any weakness in respect of my performance, it will be detected. If there is any strength in respect of my performance, it will also be detected. So at the end of the day, I'll be scored. Maybe on punctuality, I may be scored 5 out of 5. Maybe on extracurricular activity, I may be scored 3 out of 5. Maybe the way I teach, I may be scored maybe 1 out of 5. So it depends. So at the end of the day, it will be added. And out of 100, what did you get? Did you get 80? Did you get 40? What did you get? Where you fell short, that means they have detected deviation, and then the necessary corrective measures will be taken. If they are supposed to advise you, if they are supposed to organize training for you, it will be organized for you. If they are supposed to say, well done, it will be done. These are the things they do in organization, and they are able to know who is the best worker, and so on and so forth. So that is what you call performance appraisal. Then the next one is inventory control. The A students who are doing costing, this is inventory or stock control. Very simple, straightforward. Now, inventory control, stock control sets the minimum, the optimum or maximum, and then the reorder levels. It sets the minimum, the optimum or maximum, and the reorder levels. What does that mean? Okay, now you are in an organization, you buy raw materials, they use the raw materials to manufacture goods. Okay, how many bags or boxes of raw materials should you have at a time? That you shouldn't exceed that. Okay, so they will say that our maximum stock level for this particular raw material is, let's say, 100 boxes. That means they will not buy raw materials that will exceed 100 boxes. So at any point in time, the maximum raw material they will have will be 100 boxes. Then they also set the minimum stock level, and the minimum stock level will also talk about at a point in time, even if they don't have the boxes of raw material, how many should they have? So they can say 20 boxes. So at any point in time, if they don't have boxes of raw materials at all, then you have 20 there. That is the minimum. So that level, they don't want to fall below that level. And the maximum level, they don't want to go beyond that level. And if you go beyond that level, that may be costly to the organization. So, and then they have what they call the reorder level. So you have your maximum level, you have your minimum. Okay, then you can, let's say the maximum level, as I indicated, is 100 boxes. The minimum level is 20 boxes. So you know how you manufacture things and how many boxes you use in a day or in a week or so. So then you can set your reorder level at, let's say, 40 or 30. Let me say 30. So that the moment you get to 30, then you ask the supplier to supply you with that raw material. Okay, you know from your experience that by the time it comes, you know when the person brings it. So by the time it comes, you had used 10, then you left it 20. So you the reorder, you reorder 80. So that when the 80 comes and then you have the 20 there, you add to the 20 and you have your 100, so that you will not exceed your maximum level. So so if you see, this is done because if you don't do that, a time will come, a day will come, they say you are short of raw materials, and that will be bad. So if you go to somebody's store, you go to the tax shop in your school and you want to buy a particular drink, they say, oh, we don't have, it is finished. Then it means that they have not been doing this. They should have their maximum stock level, they should have the minimum stock level, and they have the reorder level. But anything can happen. You cannot predict. Maybe you may have it, but at a point in time, you may ask the person to bring, and the person may not bring the thing on time. So that is the stock control. Then the next one, so this is costing, and we are moving to costing again. Those of you who are doing costing, what you call standard costing or variance analysis. That is also another tool or device. Standard costing or variance analysis. What is it? Now, you buy materials and whatever, so cost is involved. You spend money. Now, as a manager or whoever you are, you should set your cost standard and know that this is how much I'm going to spend on direct materials. This is how much I'm going to spend on labor. This is how much I'm going to spend on A. This is how much I'm going to spend on C. So you have set the cost standard. And when you set the cost standard, then you'll be able to compare the cost standard with the actual cost. So this is how much you want to spend, but how much are you spending? So that if there is any deviation, then you take the necessary corrective measures. So that is all that standard costing is about. And we said variance analysis. Why do we say that one? Look at it. So I'm using this one to represent the SC is representing standard costing. Then the AC is representing actual costing. So now you have, let me start from here. I said, what is it? So I said it's the practice, standard costing is the practice of estimating expense. You estimate expense, the cost of production process. And I've given you what goes into it: direct labor, direct materials, and any other overheads will go into it. So how much are you going to spend on various items? So you estimate that. So it's an estimate. It's an estimate. So that is not the actual. It's an estimate. And that will be the standard costing, the standard. And then I said you use it to plan cost on various expenses, just as I've said: direct materials, direct labor, and overheads. The manufacturer will be able to compare the standard cost to the actual cost. The difference is called variance. So in mathematics, when you are doing statistics, you know what variance is all about. Standard deviation and all those things. So what is it? So if you have your standard cost, then you deduct the actual cost from the standard cost. The difference will give you the variance, and the variance is a deviation from what was recorded in the profit plan. The variance will be deviation. And what is it? If the actual cost is greater than the standard cost, it means that you are going to have lower profit. So lower profit will be expected if your actual cost. Now, okay, you said this is what I wanted to spend, but you have spent more than what you wanted to spend. That means that you are going to have, remember, you have recorded it in your profit plan. That's what you are going to do. So if you spend more than that one, then you have lower profit. Then the reverse is true. If the standard cost is greater than your actual cost, then you certainly have a high profit. You said this was what I was going to spend, but you spent less than expected, then profit will be high. So that is for that one. That is for that one. And the steps involved in this standard costing is similar to the one we did when we were looking at the steps involved in controlling. Remember, we said the first step involved in controlling is to set standard. But here we are looking at cost. So you set cost standard. You set cost standard. So when you come here, I said you determine your cost standard. You determine your cost standard. Then the second step will be measuring the cost. Then you compare the cost with or you measure the actual cost. You measure the actual cost. Then you compare the actual cost with the standard cost. When you compare and there's any deviation, you take the necessary corrective measure. So that is for standard costing or variance analysis. Then the next one, still this one, accounting. You have been doing ratio analysis or financial ratio in accounting. So that one you may even know better than I do. And if you have not learned it now, your accounting teacher one day will teach you financial ratios. But we are using it just so I'm going to give you a brief explanation as to why it is a control device or a control tool. So what is it? So I said when you say ratio analysis or financial ratio, it is a method of quantifying a company's liquidity. So the first one, you quantify, you put in monetary terms, you put in figures the company's liquidity. Now your liquidity, we are looking at your cash. Your cash. So your liquidity, the amount of cash you may have at a point in time. Your liquidity, your operational efficiency and profitability. I said it's a method of quantifying a company's liquidity, operational efficiency, and profitability. For what purpose? To evaluate its performance over time. Now, you are not doing it for yourself, but you compare with other competitors. So when you quantify your liquidity, your operational efficiency, your profitability, to evaluate your performance over time as compared to your competitors. So that is what liquidity ratio is about. How much do you have? Now you look at the other examples of those ratios. How are you able to pay for your debt? How are you able to use your assets to generate revenue or income, and so on and so forth? So we'll be doing that. Now, if somebody is an investor, they can calculate all these things and find out whether they should invest in your company or another company. So I said the ratio measures the relationship between two or more components of financial statements. I said investors use it to evaluate the financial position of a company by examining past and current financial statements to predict future performance. So they will look at your past financial statements. Then they will look at your current financial statement. When they look at the two, then they will be able to predict your future performance. And they will now decide whether to invest in your company or not. And I've given you examples of financial ratio. They have what they call liquidity ratio. So when you are calculating, in accounting, they will teach you the formula and other things. So financial liquidity ratio. This liquidity ratio will determine how easily a company can pay its debt. How easily a company can pay its debt. So the figure that they will get will determine how easy you can pay your debt so that you don't have much credit. So that is for the liquidity ratio. Then they can also calculate the profitability ratio. How good a company is making profit. That will be the profitability ratio. And you get a certain number. If you get maybe 1, then it may be good. If you get a certain number, then it may be bad. Maybe below 1, it may be bad for you. Then they have what they call leverage ratio. The leverage ratio talks about the amount of debt that the company is using to run and stay alive. So you are borrowing if you are borrowing so much, then it may not be good for you. So that one, when they calculate your leverage ratio, they'll be able to know. I'm saying that in accounting, they will give you the formulas. We are not interested in those formulas. I'm giving you the over. Probably I shouldn't have even given the types. All that you needed to know is what I've already talked about. I just decided to give you some examples of the ratios. Then you have efficiency ratio. When you hear even the name efficiency ratio, it will determine how the company uses its assets to generate income. How efficient is the company? So that is the financial ratio. Then the next one is Gantt Chart. Gantt Chart. Now this man, you already know him. When we are talking about whether management is art or science, we realized that he was a scientific management advocate. So this man came out with a chart, and that chart helped the production managers to know their project schedules. When I say project schedules, okay, I will go there to show you a diagram, and even that diagram, was your project. So you made that diagram before you went home. I'll be using it very soon. So I said the Gantt chart would. The question will be asked: what projects are being worked on? When you go there, you know what we mean by what projects are being worked on. Then, okay, how much has been completed? How much has been completed on daily basis? So every day, the production manager will look at the chart. Then, just at a glance, you'll be able to know the project schedules and how far it has gone. Now let's go to the chart. So we are looking at control tools, and one of them is Gantt chart. Now, assuming I'm a production manager. So in March, this was the chart. And if you look at here, so this is the date. This one tells us that was 1st March. But because we will not be able to write 1, 2, 3 up to 30 or whatever, we wrote 1, then 8. That means in between the 1 and 8, there is 2, 3, 4, 5, 6, or there are other numbers 2, 3, 4, 5, 6, 7. So take note of that one. Then from 7 to 15, so this is 22nd and this is 29th. And as a company, we have these orders. This is what we are going to produce. So one of the orders is order 011, and it can be anything, manufacturing of any product. Then order 1, 2 is also a product. Order 1, 3 is also a product. Then order 1, 4 is a product. Now, this is the chart. So the production manager knows that 1st March, if you look at this one, this is 1st. So from here, up to this place, that tells us that first March, manufacturing should start on first March. Then if you look at it, no, this is the plan. Oh. So this is what is there, is a plan. If you look at it, then you look at this one. Let the camera get closer so that this one. So this was the first one I was talking about. Then this is the second one. If you look at this one and you trace it to this place, then if this is 8th and this is 15th, then probably you see that this point may be 13th. So all that it means is that they have scheduled that manufacturing for order 112, which is probably manufacturing of, let's say, any product that you can think about. Let's say toothpaste. The manufacturing should start on the first, and then it ends by 13th. It is completed. Now, because we have assembling here, I cannot use toothpaste, so let me use furniture. So it will start at on the first, and then 13th it ends. Then assembling of the product should start from the 13th, and then if this is 22nd, and this is where the assembly should end, then it means we may estimate this point to be, let's say, 20th. So by 20th March, they should finish with the assembling. Then the painting, look at the painting is not starting on the 20th, but painting is starting on 22nd. And when painting starts on 22nd, then, but if this is 29th, and painting is supposed to end here, then your guess may be as good as mine. Let's say 25th, or let's say 26th, painting should end. Then testing from this time, and then it ends at this time. So that if they are supposed to even export, they export it. That is for order 112. The same thing for order 111. Order 012, they said that one maybe something that they are not doing any manufacturing, so it's assembling. So assembling should start here. So if assembly should start here, now tell me, if this is where assembly should start, tell me which day. Is it about half of it? If it's about half of it, this one, is it 4th or what? When? You can determine and tell me when assembly should start. If this is 15th and it should end here, then maybe your guess may be as good as mine, maybe 13th. So assembly should end on the 30th. Then testing here, it is testing. So testing should start on the 13th, and then it ends on the 20th. Then painting will start on the 20th, and then it ends on the 29th. So that is for that one. And so on and so for order 13 to the same thing. The order 1 for order 014. That one too. This is the schedule. So this is what you see there. Now, the production manager, so they put this one there on, let's say, 27th February. This one had already been prepared. So first is start. On the first, the production manager will go and find out whatever. So then, whatever had been done, to what extent have they done it? They are supposed to manufacture how many? Let's say 1,000. If it's 1,000 and it is from this time to this one, how many are they supposed to produce in a day? That one will be determined. So on the first, you come, what has been done? Now, the production manager is now going to, like today, if this is what they have done for today, then let's say this green thing, he's going to paint here up to a certain level. Let's say if the diagram was something like this, if it was something like that, I'm using this line as this one. Then assuming this is where this is what they are supposed to do, but this is what they have done. So he will paint this side like this. So at any time where it is painted, he knows that is what has actually been done. Where it is, so another time he comes on the second, if this is what they're able to do, he will paint up to that one. Up to, let's say, by as they are moving, then the production manager will be able to know whether they are behind schedule or ahead of schedule. If they are behind schedule, you know you are supposed to complete manufacturing by 15, but on the 8th, you are still somewhere here, then you know you are behind schedule. And that it means you have detected deviation, and the necessary corrective measures should be taken in order to be able to manufacture by the date. So if you look at what is here, I said note. I said there are 4 orders. So 1, 2, 3, 4, requiring several activities. And what are the activities? Manufacturing, assembling, painting, and then testing. So manufacture, assemble, paint, and then testing. Then in order 011, the production goes through 4 operations. So 1, 2, 3, 4. 1, 2, 3, 4. Manufacture, assemble, paint or painting, and then test. Then order 012 goes through 3 operations. 1, 2, 3. Assemble, test, and then paint. The first job begins on March 1st. So if you look at this one, it begins on March 1st, ends on 13th. So this point is on the 13th. So ends on 13th. Assemble begins on the 13th and ends on the 20th March, and etc. as we have already explained. Then he said the production manager can plot the progress. So that was what I was plotting here. I was plotting the progress. I didn't want to use the marker here in order to spoil this one. So I would have been painting like this. That means if you were around, I would have been using the marker so that after that you wash it. I don't have any water here. So if I wash it, it may affect this one, so I don't want it to be affected. So take it, so that was why I demonstrated there. So the production manager can plot the progress through each operation along with the expected time and see at a glance. When you were in school, I made you tend to see a particular diagram, the organizational chart at a glance. So you understand what is meant by to see something at a glance. So see at a glance whether the progress is on time. That's number 1. Ahead of time or behind time. And if you are behind time, then the necessary corrective measures will be taken. So that is for the Gantt chart. Now the next one is break-even chart. Break-even chart. Now let's come here and look at it before we go there. So break-even chart, which is the last control device we are going to talk about. Break-even chart. Now in costing, you'll be doing break-even analysis. And when you do that one, you look at the break-even chart, which is very important when you are doing break-even analysis. Break-even analysis is done to determine profitability at various levels of sales. In other words, if you are a sales manager or whoever you are, you should know how many products. Okay, you have spent money in manufacturing the product. Okay, you manufactured, let's say, 1,000 units of the product. Okay, how much did you spend? Okay, you spent 10,000 Ghana cedis. Very good. How many products are you supposed to sell in order to break even? What is break even? Break even, that is when you break even, it means at that point your revenue, the amount of money you had from selling the product, is equal to your total sales. No, your total cost. your total cost. Your revenue is equal to your total cost. So when you say you have broken even, that means you are neither making profit nor loss. You bought if you buy something at, let's say, 5,000 and you sell it at 5,000, you have broken even. That is break even. And that one, there's no profit, there's no loss. So if you are a manager, especially the sales manager, you should know that I have manufactured 1,000 products. I spent 10,000. How much is one? How many products should I sell in order to get to a point where I have broken even? Assuming you have to sell, let's say, 500 of the product before you get 10,000 Ghana cedis. Then it means that at 500 units, when you sell 500 units, when you sold one, you were making losses. Two, up to 499, you were still making loss. Then you sold them 500 product. Then that one, as soon as it was sold, somebody bought, you sold 500. Then that one, you broke even. So you have neither made profit nor loss. When you said 501, then you have started making a profit. And you use the break-even analysis to determine that one. And the point that I said, this is BEP's break-even point. At that point, your revenue from sales is equal to all costs. Why are you saying all costs? Because cost can be either you have what you call fixed cost, and you have your variable cost. And you do all these things, and even economics, they will teach you about fixed cost and variable cost. Costing, you learn about fixed cost and variable cost. But it's very simple. When you say fixed cost, you know, when you are producing, there are some costs. It doesn't matter the output, the number of products. Even if you produce 1 unit, the cost is fixed. If you spend 1,000 and you produce 1 unit, it's still 1,000. If you spend 1,000, you produce 2 units, still 1,000. If you spend if it is 1,000 and you produce 1,000 units, it's still 1,000. But there are some of the costs, they change. As output increases, it will also increase. So that is called variable. You know, when you say something is variable, it means it lends itself to changes. So you can have fixed costs, you can have variable costs. Now you see your management book. Whether first you have to type, the author has to type the book. The one who typed will charge, let's say the person charged 1,000. The person doesn't care whether you are going to produce 1 book, 2 books, or whatever, you pay the 1,000. But you see, the papers that you are going to use, if you buy 1 ream, you have 500 sheets inside. Now, assuming the book is 100 pages, or 100 pages, that means 50 sheets. That means if all things being equal, if nothing gets spoiled, that means 1 ream will be able to make 10 books. So if you want to make 100 books, it means you have to buy 10 reams. And the amount of money involved in buying 10 reams, if you want to make that number of books, will not be the same as if you are making less or more. So in that one, you say that is a variable cost because it changes with output. And if you want to produce more, you have to buy more of that and you pay more. But there are some like the typing, and you pay the same whether you are making 1 or 2 or whatever. And that is so. If all the costs come together and it's equal to the revenue, then you say that will be break-even point, your break-even point, and the chart will show us that. So break-even chart will show the contribution. Now this contribution here is not the ordinary English language, so I'm contributing to this. No, this is a special term in costing. You learn it's contribution. And what is contribution? I will know it very soon. So break-even chart shows the contributions at various levels of sales. So how many have you sold? And what is the contribution? So what is that contribution? Contribution is equal to your sales minus the variable cost. So when you say contribution, you know you have sold something. You had your variable cost. So when you deduct, you have to bring all the variable costs together. Then you deduct from your sales. Then that is what they call contribution. So if you want to make your profit, then now that you have your contribution, you deduct your fixed cost from the contribution in order to get your profit. And I've given you this simple problem here. Assuming your total sales was 10,000 Ghana cedis. Then the fixed cost was 2,000 Ghana cedis. Variable cost was 3,000 Ghana cedis. Then you are asked to calculate contribution. Then we said contribution will be equals to sales. Now the sales was 10,000 minus variable cost, which is 3,000. So the contribution will be 7,000 Ghana cedis. Then they say, now calculate the profit. Now that you have had your contribution, then you have to deduct your fixed cost, which is the 2,000, from the contribution. So profit will be equal to 7,000 Ghana cedis minus 2,000 Ghana cedis. That will give you 5,000. So in other words, your profit is now 5,000 Ghana cedis. Now let's go here and let's use the diagram to explain. Now look at this diagram. This is what you, this